Hey guys, and welcome back to the 365 Days of Forex series. Before we get started, if you're enjoying this video series so far, give us a like and subscribe, and maybe even drop us a comment down below if you've got a suggestion of what you want us to cover in the next couple of videos. In today's video, I'll be introducing you to the Fibonacci sequence, Fibonacci retracements, Fibonacci extensions, and a cool little concept that I call Fibonacci zones, which is an awesome way to add profitability to your Fibonacci trades. Without further ado guys, let's get into today's video. In 1202, an Italian mathematician called Leonardo Fibonacci, who is more commonly referred to as Fibonacci, developed a number series where you can add the two prior numbers together to form the sequence, which goes 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and then continues all the way up to infinity, but sadly we can't recall all that. When he analysed this sequence, Fibonacci realised that each number was around 1.618 times greater than the preceding number. As a result of this, the 1.618 value was then seen as the golden ratio, and is strangely seen in many other areas of life such as biology and fine art, within things like Da Vinci's paintings of the Mona Lisa, sunflowers, rose petals, tree branches, human faces, and, just to nerd out a little bit, even the spiral galaxies in outer space. In short, it's pretty awesome and it can be found almost everywhere in nature. Although this is all very interesting, I'm sure you're all here to find out how you can use Fibonacci in your trading and how to make those sweet profits. With that being said, let's look at Fibonacci retracements. Fibonacci retracement levels are horizontal lines that can be used to suggest where support resistance will form depending on which way the market is trending. Each level is associated with a percentage that has been derived from the Fibonacci sequence, with the percentage denoting how much of the prior move that price has retraced. For example, if we have a move from 0 to 100% and price retraces back to the 70% mark, this is a retracement of 70% of the initial move. This is the exact same logic for any of the following Fibonacci percentages that you'll see in this video. The most commonly seen Fibonacci levels correspond to a retracement with the following percentages: 23.6, 38.2, 61.8, 78.6%. Whilst not derived from the Fibonacci sequence, the 50% is also used due to the significance of a 50% retracement of the move, which is half. It's also important to note that Fibonacci levels are additive and divisible. This simply means that the more Fibonacci levels can be found between the more commonly ones used by looking at the ratios between the two larger levels. One of the less common Fibonacci levels that you're likely to see being used is the 70.7% level, so keep this in mind as we get deeper throughout the series. Like most technical analysis tools, Fibonacci retracements tend to work more consistently on the higher time frames, so when you're first starting out, I would suggest sticking to the 1 hour and above. Also, it goes without saying that we should always be looking to utilise the Fibonacci retracement tool as a confluence with other trading technical tools, such as support and resistance and moving averages. Let's take a look at an example of this on the FXE whiteboard, which should be on the screen right now. So as you can see, I've taken an extract from the Fibonacci sequence and added it to the FXE whiteboard. Here you can see the numbers 5, 8, 13, 21 and 34. These numbers have a pretty special relationship, and that relationship can be found when you take the numbers and divide them. Let's take 34 and 21. If you divide those numbers, we can find what's called the golden ratio as mentioned before, which is roughly 1.618. If you want to know the mathematical formula for calculating that golden ratio, it's the square root of 5 minus 1 all divided by 2. With all that in mind, let's head over to Trading View and look at how we can actually use these levels and the Fibonacci trading tool. To get the Fibonacci trading tool on your chart, you need to go across to the left hand side of the window and select the arrow to the right of the pitchfork symbol, which will give us the drop down list of different tools that we have available to us. You can then go ahead and select the Fibonacci retracement and place it on your screen. To set up the Fibonacci tool to stop it looking like some sort of rainbow, you can click in the settings and deselect a lot of the options that are currently shown. I personally also like to remove the background from the Fib tool by changing the transparency to 0, which is done with this slider here. I would also suggest changing the Fib levels from values to percentages, as well as changing the label to show the information on the right hand side instead of the left, as it can become very confusing when you have to read the tool on the charts. Once you've done this, I would suggest saving this as a template so you can just reapply your template if you accidentally change something in the future. So now let's look at why we use the levels that we do. The first level is the 0% or 100%, which we placed on the swing high and swing low point of the move. Following this, we can see the 38.2% level, which is derived from dividing 8 by 21, which will give you 0.382. This can be done with any of the Fibonacci numbers with the same respective spacing, for example dividing 13 by 34 or 21 divided by 55. The second level we can see is the 50% level. Whilst this is not a Fibonacci level, it's seen as a very popular area that price can reverse and was recognised by Gann as well as Dow. Following this level, we can see the golden ratio, which is the 61.8% level. This is a Fibonacci level and it's calculated by dividing two adjacent numbers, such as 8 by 13, This is the inverse of the true golden ratio, which would actually be found by calculating 13 divided by 8, which would be around 1.618, as we mentioned previously. The fourth level I've noted on here is the 78.6% level, and this is not actually strictly a Fibonacci level, however it's the square root of 0.618, and therefore it's seen as a valid level. I actually use this level and mark the end of my retracement, and if prices manage to push through and close through the 78.6 level, then I would see the setup is invalidated, and I would say the trend is probably reversed rather than just retraced. Now we know where the levels we use come from. I've outlined some super basic examples using the Fibonacci retracement tool below this video. In the following lessons, we will cover how to use this tool within your trading as a confluence, as well as the tool's limitations. Let's take a look using some super basic examples of how we can use the Fibonacci tool in TradingView for potential setups. One of the more common questions I get about Fib retracements is whether placement is on the wicks or bodies of the candles. This is an example of placing the Fib on the wicks, whilst this is an example of placing the Fib on the bodies. Where you place your Fib is of course down to personal preference, but on shorter term time frames, it's generally accepted that you should place your swing high and swing low from the wicks of the candles. However, whatever you do, it doesn't actually really matter, because all you need to do is just remain consistent and stick with it. Another incredibly important point that I touched on earlier is that the Fib should be used in the direction of the dominant trend, and you want price to pull back to one of the retracement levels before continuing in the direction of the dominant trend. You can also see here this example rejects the 50% retracement level, and you can clearly see the higher highs and higher lows associated with the uptrend. Most traders will also give greater importance to the different Fibonacci levels, with the 61.8% being viewed as the golden point, whilst people also use the area between the 50% and 61.8% as the golden zone. An easy way to incorporate this into your trading system is perhaps only entering from the golden level or the golden zone, although you may favour using other retracement levels if you've found different results. The second way to discriminate between Fibonacci levels is the strength of a trend that you are using the Fibonacci retracement level on. The strength of the trend can usually be quantified by placing a trend line and then by taking the angle of this trend line. Let's look at an example. Here you can see a relatively shallow trend line, suggesting that the trend is not particularly strong. And from this, you can propose that the retracements are likely to be larger than in the very strong trends. Here you can see that this retracement actually satisfies a rejection of the 78.6% level, which, if we now take a look at this example, you can see that this stronger trend creates a reaction from the 38.2% level. The final point I touch on would be the use of Fibonacci retracement levels in placing your stops. If you want to see price hit a Fibonacci retracement level, reverse at a level such as the 61.8% as it lines up with the level of structure. Placing a stop loss beyond this level is likely a good area to put it, as if price breaks through the level, then it clearly is an invalidated trade. Even though Fibonacci retracements are some of the more commonly used technical analysis tools, I see many people using them in very unusual and frankly potentially incorrect ways. The final point I will make on the limitations of Fibonacci retracement levels is that there actually isn't any proof that this really works. The only remotely relevant is in Dow's theory that price moves in zigzags, and hence retracements need to occur for the markets to work. The Fibonacci retracement levels themselves basically rely on other market participants also using this tool, and then seeing similar things to yourself, and hence the tool acts as some sort of self-fulfilling prophecy. Let's now take a look at how we can use another Fibonacci tool, Fibonacci Extensions. Essentially, Fibonacci Extensions are a tool that traders can use to identify potential levels to place profit targets after entering a trade following a retracement. As you'll see in just a second, Fibonacci Extensions will appear past the 0% retracement line. I know this sounds a little bit complicated, so let's take a look at an example just here. As you can see from this screen, we've got a Fibonacci retracement drawn from left to right. If we pretend that our line represents price action, we can draw a line from the 100% level, which represents our swing low at the bottom of the screen, like we are on an uptrend, up to the 0% level. Let's say we now have a pullback at the 61.8% level, which is of course the retracement of the 61.8% of the initial swing from the swing low to the swing high. If we now pretend that there was a price action rejection at this level, we could decide to establish a position here. Our entry would be at the close of the rejection candle, and our stop loss could be placed under any of the Fibonacci levels. So for this sake, let's just say it's under the 78.6% level. However, the next question we should be asking ourselves is where we're looking to take our profits. With just Fibonacci retracements on our Fib, it gets really hard to answer that question unless you're just being really conservative and you're just looking for a return to a later Fib level. You may also decide to go for market structure, such as say a double top region. However, let's now switch our minds onto the Fibonacci extension levels, with the most common ones being minus 27.2, minus 41.4, and the minus 61.8% levels for shorter term traders, and potentially even the minus 100% and the minus 161.8% levels for longer traders. You'll actually see a minus sign in front of the Fibonacci extensions, but don't get confused on this, as the Fibonacci retracement tool class of retracements is positive and the negative percentages as extensions. Got it? Let's move on. Like Fibonacci retracements, the extensions actually do make theoretical sense when you think about them. The minus 27.2% is just 27.2% of the initial move added on top of the 0% level, and the minus 168 is just 161.8% of the initial move added to the 0% level. Now I have these marked on our chart, we can use these as an indication of where we're going to place our take profit levels. Going back on our oral trade, we can now see that we're going to define our entry using the rejection Fibonacci retracement tool, place our stop loss below the Fibonacci retracement level, and then place our take profit at one of our Fibonacci extensions. Let's say, for example, the minus 27.2%. Which Fibonacci extensions level you use in your trading is down to personal preference and your backtesting data. Whilst it would be nice to always be able to see our targets go on to this level, we need to be more realistic, and that is why we use an interim level at the 127.2%. And whilst this would almost be impossible to quantify the exact probability of the 1.168% being hit compared to the 127.2% level, it should be relatively obvious that a less ambitious target is more likely to be triggered when compared to a more ambitious one. This being said, there are some telltale signs which you can look out for when deciding which level will be suitable for your trade. The first is looking for other market structure around the levels that you're targeting. If there's a solid level of resistance between the minus 27.2 and the minus 618 and you're going long, then it's probably sensible to set your target at the minus 27.2 unless you plan on waiting for that resistance to be smashed through, which may not even happen. The second is looking at how significant the retracement was compared to the overall move. If you're going short and you're ending at this 38.2% retracement level, then it's a lot more likely that price action will have enough momentum to push through the minus 27.2 and on to the minus 61.8 when compared to a trade that you ended with a retracement at the 78.6% level. This being said, you should never just assume this is a factor on every asset, as this varies in volatility and trend strength is constantly changing. The final decider between which level to target should be based on your own previous trading history. Make a constant note of whether your trade's going to hit both these levels or whether you find price action exhaust before hitting this more ambitious minus 61.8% extension. One final important tip about trading with Fibonacci extensions is to place your profit a couple of pips before these levels, as many traders are using these Fib extensions to exit positions, so these levels can become quite volatile and your take profit over might not always be filled by your broker. In my opinion, sacrificing a couple of pips is way more worth it, ensuring that your order is getting filled. You should now have a lot better understanding about how to use Fib extensions, but you definitely need to practice implementing them into your live trading or backtesting, as they're extremely easy to identify retrospectively, but are much harder to utilize in real time. Therefore, using them in hindsight can often lead to a false sense of profitability, which is then not really replicated in your live trading. The next use of Fibs in trading is a handy tool I like to call Fib Zones. The main concept using Fib Zones is to an area where there are multiple swing highs and swing lows. Place Fibonacci retracements on each and then find an area where multiple retracement levels overlap. The idea behind this is that if there are a few places a Fibonacci retracement could be placed, by layering them on top of each other, you'll find the area that has the highest probability of a reversal. Here you can see price action is in a very prominent uptrend, and hence we want to only be looking for long positions. If we look for swing lows to place our Fib retracement from, there are actually a couple of candidates that we can choose from. For example, here and here. However, it's very obvious that there is one swing high on our screen, right at the top of the uptrend just here. If we then place two Fib retracements, one from the lower swing low and one from the higher swing low, both ending on the same swing high, we end up with the right royal mess on our screen. However, if you do have keen eyes, you can see there's an area where two of the Fib levels just about match up, which is right around here. If we clear our chart by removing some of the Fib levels, we can see this clearer, with the 50% of the larger Fib retracement matching up almost perfectly with the 61.8% level from the smaller Fib. Here is what I like to call a Fib zone, which is where multiple Fibonacci retracement levels overlap and hence have a high probability that other traders are seeing the same things that you are, which undoubtedly makes a better trade. If we then wait for a price action rejection at this level, and if it occurs, establish a long position, you have a trade that has a good chance of going on and hitting that target of yours. Of course, you can look to increase confluences by using structure and good stuff like that, but we'll go on to that in another video. Like other things that we've spoken about recently, we will come back and examine Fib zones in greater depth later on in the course. For now though, that just about wraps up this video, and with all that in mind, be sure to hit that subscribe button and the notification bell to get notified when we upload the next episode in this course, which will be in 2 days' time. Cheers guys, now I'll see you in the next one.